Hello everyone, today I'm going to talk about private placement memorandums, term sheets and regulation, and due diligence. First, I'm going to start with private placement memorandums, or PPM. It's a prospectus for raising capital in exchange for equity in a private firm, like a prospectus given to investors for mutual funds, stocks, and other publicly traded securities. The PPM goal is to disclose information to raise capital by captivating investors into performing due diligence and investing. For example, 7Key Software in 2017 announced a PPO to reduce costs and bring past business leaders to the opportunity to change 7Key Software forward-looking vision, direction, and priorities. The PPM structure includes, but not limited to, the offering summary, risk factors, capitalization of the company, and the use of proceeds. Next, we have the term sheet anatomy. The term sheet anatomy lists the basic terms and conditions of a non-binding agreement under which future investments will be made. The term sheet is used as a template to make a legal binding document between the involved parties. After all parties must agree to the terms, then a legal binding document can be drawn up. The term sheet structure includes, but not limited to, the investors, amount of investment, number of shares, price per share, rights, preference, and privileges. Next, we have the regulation of PPMs. Although there's a lot of private placement laws, the most used is Regulation D of the Securities Act of 1993. The advantage of Regulation D is that funds can be obtained faster and at a lower cost compared to a public offering. Securities Act of 1933 raised capital through Regulation D. There are some exceptions, each with a slightly different restriction that apply to companies raising capital under $1 million, $5 million, and unlimited funds. Next, I'm going to talk about due diligence. Due diligence is an audit, investigation, review done by a business or person that is expected to take to confirm facts of a subject under consideration before entering into a contract or agreement with another party. For example, before entering a proposed financial transaction with another business, due diligence requires the examination of the financial records. Another example of due diligence is evaluating a business before an acquisition. In the case of a PPM, due diligence starts by evaluating the terms and risk factors that come with the acquisition of private equity. This concludes this presentation on private placement memorandums, term sheets and regulations, and due diligence. Thank you for listening.